Imagine walking into a year where markets punish hesitation, reward overconfidence for exactly 5 minutes, and then destroy it without warning. A year where headlines move billions, volatility rewrites rules overnight, and only a handful of strategies survive intact. Now imagine delivering a double-digit return inside that storm. No shortcuts, no luck, just precision under pressure. That is the reality of 2025, and the story most people don't understand yet. In a year where markets refused to move in straight lines, where headlines shifted sentiment overnight and volatility became the only constant, delivering a 10.2% return was not a matter of luck. It was a matter of discipline. This performance was achieved in an environment defined by rising interest rates, geopolitical tension, uneven global growth, and aggressive competition across asset classes. When capital is tested by uncertainty, results like these reflect something deeper than timing. They reflect a framework built to survive pressure and convert complexity into opportunity. The reality of modern markets is unforgiving. Liquidity can vanish in seconds. Correlations that once held can break without warning. In such conditions, chasing momentum is a dangerous game. The focus instead must remain on preparation, on understanding how risk behaves when assumptions fail. A double-digit gain in this environment sends a clear message. Success comes from controlling downside as aggressively as pursuing upside. Capital preservation is not defensive, it is strategic. It creates the freedom to CT decisively when others are forced to retreat. This return was earned by operating with precision across strategies, not by overexposing to a single theme or macro bet. It came from balancing conviction with humility, knowing when to press and when to step back. Markets reward those who respect them, and they punish those who underestimate uncertainty. Every decision reflected a belief that volatility is not an obstacle, but a resource, if managed correctly. The goal was never to be loud, but to be right more often than wrong. What makes this performance meaningful is not just the percentage itself, but the context around it. Equity markets delivered strong gains, yet they masked sharp drawdowns beneath the surface. Fixed income experienced regime shifts that challenged long-standing models. In that backdrop, maintaining steady progress required constant adaptation, real-time risk assessment, and a refusal to become complacent. The edge came from process, from systems designed to absorb stress without breaking. This is what institutional investing looks like at its core. It is not about reacting to noise. It is about filtering signal from chaos. It is about building teams, technology, and decision-making frameworks that function when pressure is highest. A 10.2% return under these conditions demonstrates that resilience is not accidental. It is engineered. It is reinforced every day through rigorous analysis, accountability, and an uncompromising standard of execution. Ultimately, performance like this reinforces a simple truth. Markets do not reward emotion, narratives, or optimism alone. They reward preparation, discipline, and respect for risk. When uncertainty dominates the landscape, the objective remains unchanged: deliver consistent results without sacrificing long-term integrity. That is how capital compounds. That is how trust is earned. And that is how success is defined when conditions are hardest, not easiest. Performance only matters when it is measured against reality, not aspiration. In 2025, the hedge fund landscape was intensely competitive, with capital concentrated in the hands of a few global platforms, all pursuing the same objective: consistent, risk-adjusted returns in an unstable world. Some firms posted outsized numbers, others struggled to protect capital, and many discovered that scale alone does not guarantee resilience. Within that context, a 10.2% gain stands as a statement of durability rather than spectacle. It is easy to be impressed by headline returns in strong equity years, but institutional investing demands a deeper lens. Markets in 2025 rewarded risk selectively and punished overconfidence brutally. Crowded trades unwound without warning, macro narratives reversed in weeks, and leverage became a liability for those who mistook favorable conditions for permanent ones. Against that backdrop, the true measure of success was not whether returns topped a ranking table, but whether capital grew without exposing investors to existential risk. This is where perspective matters. Comparisons across the industry reveal a sharp divide between performance driven by structural strength and performance foile, D by temporary tailwinds. Some strategies benefited from concentrated exposures that worked until they didn't. Others relied on directional bets that aligned with market momentum. The discipline here was different. The objective was not to win every quarter, but to remain relevant in every market regime. That requires a willingness to sacrifice short-term acclaim in exchange for long-term credit. Volatility. A double-digit return in such an environment reflects a portfolio designed for continuity. It acknowledges that markets evolve faster than narratives and that risk must be managed dynamically, not defensively. The emphasis was placed on diversification across strategies, rapid capital reallocation, and constant stress testing of assumptions. When conditions shifted, the response was not hesitation, but recalibration. That adaptability is what separates enduring platforms from fleeting success stories. The broader industry context also underscores another reality. Size magnifies both opportunity and error. Managing vast pools of capital demands restraint, transparency, and an infrastructure capable of absorbing shocks. Performance achieved without compromising those principles ES more weight than any isolated spike in returns. It demonstrates that scale and discipline can coexist, but only when decision-making remains grounded in data and accountability. Ultimately, this result reinforces a core belief. Sustainable performance is not about dominating a single year, but about proving relevance across decades. Markets will always produce winners and losers in any given cycle. What endures is a philosophy built around risk awareness, intellectual honesty, and execution under pressure. In 2025, a 10.2% gain was not a victory lap. It was confirmation that consistency, when pursued relentlessly, remains one of the most powerful advantages in finance. At the heart of this performance was a simple principle executed with extreme discipline. Diversification is not about owning many things. It is about owning the right mix of risks. In 2025, markets repeatedly reminded investors that concentration, no matter how confident the thesis, can become a liability overnight. Correlations shifted without warning, macro signals contradicted themselves, and strategies that relied on a single narrative found themselves exposed. The strength of the result came from refusing to rely on any one engine to drive returns. The portfolio was constructed to function as an ecosystem rather than a collection of isolated bets. Quantitative strategies provided speed, scale, and objectivity, absorbing vast amounts of data and translating market inefficiencies into repeatable outcomes. These systems did not react emotionally to headlines. They responded to probabilities. In periods of heightened volatility, that discipline mattered. When markets moved faster than human instinct, automation and rigorous modeling preserved consistency. Equities, on the other hand, demanded judgment. Stock selection in 2025 required an understanding of not just fundamentals, but positioning, liquidity, and policy sensitivity. Returns were uneven. Leadership rotated aggressively in valuation discipline became essential. The contribution from equities reflected an approach rooted in research depth and risk awareness, not broad market exposure. Capital was allocated where conviction met asymmetric payoff and reduced when the margin for error narrowed. Fixed income and credit strategies added another layer of balance. As interest rate expectations evolved and yield curves shift. These strategies were not treated as passive ballast, but as active sources of return and risk control. Duration was managed dynamically, credit exposure was scrutinized relentlessly, and capital was deployed with an understanding that stability itself can generate opportunity when others are forced sellers. Perhaps most importantly, tactical trading strategies served as connective tissue across the platform. They allowed rapid responses to dislocations, short-term inefficiencies, and volatility spikes that long-only approaches could not exploit. These strategies thrived not because markets were calm, but because they were unpredictable. Volatility, when approached with preparation rather than fear, became an asset. What unified all of these components was a single operating mindset. O strategy is entitled to capital. Allocation is earned every day through performance, risk behavior, and relevance to current market conditions. This internal competition enforced accountability and prevented complacency. When a strategy underperformed or its risk profile changed, capital was reallocated without hesitation. The result was a portfolio capable of absorbing shocks while still pressing advantage. Gains did not depend on one perfect call, but on thousands of disciplined decisions made consistently across teams and systems. That is how resilience is built, not through bold promises, but through architecture designed for stress. In a year like 2025, diversification was not a defensive posture, it was an offensive advantage. By blending quantitative precision, fundamental insight, and tactical agility, the portfolio delivered progress without fragility. That balance is not accidental. It is the product of a belief that sustainable performance comes from respecting complexity, managing risk holistically, and never allowing confidence to outrun control. Markets have a way of exposing complacency, and 2025 was unforgiving to anyone who confused favorable trends with PE. Permanent conditions. On the surface, broad equity indices delivered impressive gains, creating the illusion of simplicity. But beneath those averages was a market defined by sharp rotations, sudden drawdowns, and narrow leadership. Many portfolios that appeared strong on paper were one shock away from unraveling. In that environment, delivering steady performance required more than participation. It required control. The challenge was not capturing upside alone, it was doing so without inheriting the full volatility embedded in the market. Equity rallies were powerful, but they were also fragile, driven by crowded positioning, policy expectations, and rapid sentiment shifts. Exposure had to be earned, not assumed. Risk limits were not abstract guidelines, they were enforced boundaries, aimed to ensure that no single outcome could define the year. That discipline allowed progress even when markets tested conviction. Resilience came from treating risk as a dynamic variable, not a static assumption. Every position was evaluated not just on expected return, but on behavior under stress. How does this trade perform when liquidity dries up? What happens when correlations spike? How deep? Always it respond when the macro narrative reverses? These questions mattered more than forecasts. The objective was never to predict the future perfectly, but to remain functional when predictions fail. This approach stood in contrast to passive exposure. Riding an index upward can feel rewarding, but it offers little protection when conditions turn. The strength here was selective engagement, PAR. Anticipating where the reward justified the risk and stepping aside when asymmetry disappeared. That selectivity reduced drawdowns, preserved capital, and created the flexibility to re-enter when opportunity re-emerged. In volatile markets, flexibility is a competitive advantage. Risk management was not about avoidance, it was about optionality. By limiting losses and smoothing volatility, the portfolio retained the ability to deploy capital aggressively at moments of dislocation. When others were forced to deleverage or explain losses, the focus remained on execution. Stability created opportunity. That is a principle often misunderstood, but repeatedly proven in practice. What made this especially relevant in 2025 was the speed of change. Market regimes shifted in weeks, sometimes days. Policies evolved, expectations reset, and narratives collapsed under their own weight. The ability to adapt quickly, supported by data, technology, and empowered decision-making, determined outcomes. Rigid frameworks broke down, adaptive ones endured, the performance achieved. During this period reflected respect for that reality. It showed that risk management is not a constraint on returns. It is a prerequisite for sustainable ones. Protecting capital during turbulence is not conservative, it is strategic. It ensures survival, relevance, and the capacity to compound over time. In the end, markets do not reward bravado. They reward preparation, humility, and execution. And under pressure. 2025 reinforced that lesson clearly. Steady gains in an uneven market were not a coincidence. They were the result of treating risk as seriously as return. That balance between ambition and control remains the defining edge when markets refuse to cooperate. Results are only meaningful when they point forward, not backward. A 10.2% return in 2025 was never viewed as a finis. H-line, it was a signal, a confirmation that the foundation in place is capable of compounding in environments that test conviction. Markets evolve relentlessly, and success belongs to those who prepare for what comes next, not those who celebrate what has already happened. The real work begins after performance is delivered. Looking ahead, uncertainty is not a temporary condition. Structural ifs in interest rates, geopolitics, technology, and capital flows are reshaping how markets behave. Old playbooks are becoming less reliable, and linear thinking is increasingly dangerous. The response to that reality is not hesitation, but investment in people, in systems, and in ideas that can adapt at speed. Progress depends on staying ahead of change, not reacting to it. The future demands a platform that learns continuously. Data alone is not an advantage. Interpretation is. Technology must enhance judgment, not replace it. The focus remains on building tools that identify risk earlier, allocate capital more efficiently, and uncover opportunities others cannot see. That requires patience, resources, and a culture that values precision over noise. Innovation in this context is not about novelty. It is about durability. Talent remains the most decisive factor. Markets are shaped by human decisions, and the ability to attract and retain exceptional minds determines long-term relevance. That means fostering an environment where accountability is clear, debate is encouraged, and excellence is non-negotiable. Performance is not the product of individual brilliance alone, but of teams aligned around a shared standard. When pressure rises, culture is what holds. Capital discipline will remain central. Growth for its own sake is a trap. Scale must enhance opportunity, not dilute it. Every allocation decision must continue to earn its place through performance and risk behavior. That rigor ensures that flexibility is preserved, allowing rapid shifts when conditions change. In a world where liquidity can evaporate quickly, agility is not optional. It is essential. Perhaps most importantly, the commitment to clients remains unchanged. Trust is built over time and lost quickly. Delivering consistent, risk-aware results is not just an objective, it is a responsibility. That responsibility demands transparency, humility, and a relentless focus on long-term outcomes than short-term validation. The year ahead will present new challenges, new volatility, and new narratives competing for attention. Some will prove meaningful, others will fade. The approach remains steady, evaluate rigorously, act decisively, and manage risk without compromise. That is how performance is sustained beyond a single year. In the end, markets will continue to test resolve. They always do. The measure of success will not be one year's return, but the ability to compound capital across cycles, adapt without losing identity, and remain relevant when conditions are hardest. That is the standard. Everything else is noise. And here's the truth most won't tell you. Markets don't crown winners in easy years. They expose them in hard ones. When volatility fades, anyone can look smart. But when uncertainty takes control, only discipline survives. A 10.2% return in 2025 wasn't the climax. It was the signal. A signal that preparation beats prediction, structure beats emotion, and conviction backed by control always out. Ass noise. The market will move on, the pressure will return, and when it does, only those built for chaos will still be standing.